What you're about to view is an exciting presentation on emerging real estate markets. If you take action and decide to become involved in emerging real estate markets, you will discover a very little known avenue for creating a windfall of cash flow and profits that will get you to your financial goals faster and easier than you knew possible. Hi, my name is Brian Adams. I'm the founder and managing partner of Adams Investor Group LLC. I specialize in being able to locate and buy solid income producing properties. I do so in a marketplace that is growing and will allow our investments to grow and produce incredible future values. If you have a similar goal and you'd like to learn more about becoming involved, get ready for a wealth of information in this presentation. Now would be a great time to grab pen and paper, as I'm sure you're going to want to take down some notes. Before we jump into the emerging markets presentation, all information and materials presented are provided for educational purposes only. All parties are encouraged to consult with their attorney, accountants, and other advisors and perform own due diligence on this topic. For this presentation, I have three objectives. The first is explain what an emerging real estate market is. The second is to have you discover the advantages of emerging real estate markets. And your third objective is to show you how you can take it the next step and start investing in emerging real estate markets yourself. By now you're probably asking yourself, Brian, what is an emerging real estate market? Well, an emerging real estate market is a market that has the potential to appreciate very quickly within the next 3 to 5 year period. It doesn't matter what the national economy in the United States is doing, because throughout the United States there are several markets that are emerging. They're micro markets that although the economy may be doing very well, or the economy may be doing very poorly in the United States as a whole, there are markets that are appreciating very rapidly. Many investors, after listening to this presentation, have decided to invest themselves in emerging real estate markets. Let me give you an example of an emerging market. Back in the 1990s, in Phoenix, Arizona, Sun Microsystems created a headquarters and also a campus facility that created over 20,000 new jobs in the marketplace over a 3-year period. That market appreciated over 42% over that 3-year period and continued to appreciate into the 2000s. In Dallas, Texas, between the years 2005 to 2008, the Metroplex being Dallas-Fort Worth, attracted new jobs into the area. The market appreciated over 46% within that time frame, and it continues to appreciate today. The key to emerging real estate markets is job growth. What we do is follow job growth throughout the United States. Job growth is the only thing that will take a market that has been downtrodden or has been slow and put it into the recovery phase. Our focus is to discover where the jobs are going, why they're going there, and more importantly, follow the migration of people into those job growth areas. Because we do that, we prosper. Let's now talk about market cycles, what they are and what the strategies are for investing in them, and also what determines which particular phase of a market we're in. Now at any given time, any market, any city, any town in the United States, Canada, North America, and other countries throughout the world are going to be in one of the 4 phases of a market cycle. They'll be in what's called a seller's market phase 1, a seller's market phase 2, a buyer's market phase 1, and a buyer's market phase 2. This is a typical cycle. This is the path that all markets take. The good thing about this path is that we know that these phases, the 4 phases of a market cycle, always follow each other in this particular order. Because of that, we can be prepared to change our strategies as the phase changes. One of the key mistakes that real estate investors make is that their market cycle is changing and they're unaware of it. Because of that, they don't change their strategy. Eventually, they get caught holding the bag. They buy a property that they really shouldn't have bought, and they're holding it for a time period where they really should have sold a while ago. The whole idea between market cycles and market phases is the fact that these phases are changing about a year before the media recognizes it. What you want to be doing is changing your strategy about a year before the newspapers and the media are reporting the changes. You may remember a time when the media was saying, buy real estate, buy real estate, buy real estate. They talked about how much money people could make in the real estate market. All of a sudden, 6 months later, the real estate market crashed. A lot of people got caught holding the bag. That was because the market actually started changing about a year prior to that, and anyone that knew about market cycles and market phases had already been selling off their properties and did not get caught holding the bag. There are times when the media are saying, don't buy real estate, times are tough, stay on the sidelines. Typically, that is the best time to be buying because the market had already started changing. It already started creating momentum. We're going to talk about that momentum. Just so you know, the average time that it takes a market to cycle is anywhere between 8 to 12 years. The average time between these phases is anywhere from 3 to 5 years. Let's walk through these phases. I'm going to give you the key characteristics of these phases and the key strategies that you should be using at any given time. By watching this video, you can actually take this newfound knowledge of market cycles and use this in your own backyard. You should always be investing in your own backyard or your home state. Start with the seller's market phase 1. The key characteristic is supply in the marketplace starts to dwindle. This is the backside actually of the emerging market. Supply starts to dwindle because people are scooping up properties fast, especially speculators. Properties are selling very quickly in this particular market phase. We ourselves are considered very conservative investors. The only properties we buy are properties that cash flow properly. Eventually you can make a lot of money speculating, but we rather be very conservative in our investing. If something happened in the marketplace where it changed very quickly, unforeseen, then we'd be safe because our properties are producing solid cash flow. Whereas speculators buy based on potential future value increasing rapidly. Then they plan on selling out and obtain all the appreciation in terms of cash. The problem with that is if the market changes very quickly and you can't sell your property, then you have a property that has actually started depreciating in the sense that it's losing value. A lot of people in the late 2000s, 2007, and 8 got stuck holding the bag on properties that they speculated on, couldn't sell the property, and now upside down on those properties, meaning they can't resell them for what they paid for them. As a conservative investor, we're always looking for our properties that cash flow properly, so that does not happen to us. Also, some key characteristics on a seller's market phase 1 is that the time on the market is actually at its lowest point. That is the time that it takes a property to become under contract. At one point in this particular phase, you'll actually see bidding wars for properties. Who remembers when there was a time when you heard about a property going on the marketplace for let's say $500,000 and it gets bid up to $550,000 or $600,000, and this happens because of the strong demand and there's a lot more investors in the particular market phase. Some other characteristics of this phase are unemployment is low, property prices and rents are rising, and the key characteristic of all is that demand is at its highest point. Because demand is at its highest point, we can do the two strategies of real estate investing, which are either buy and hold or flip. This is the only stage where we can do both. The reason being because demand is so great in the market. We can buy and hold and realize a whole bunch of appreciation, or we can realize that appreciation and flip that property and buy an even bigger property. That is called trading up. One of our strategies is to trade up to a bigger property. When our market appreciates, that property value is worth a lot more. For example, if the market appreciates by 10% on a $2 million property or appreciation of $200,000, and you compare that to a property worth maybe $200,000 at that same 10% appreciation, well, that's $20,000 of appreciation. What would you want more? Same amount of effort to do some of these apartment deals, just a lot more appreciation on bigger deals. Let's go into a seller's market phase 2. Now we're going to transition to probably the riskiest of all market phases. The seller's market phase 2 is 3/4 of the way up that roller coaster, and it ends about 1/4 on the other side. That's what makes it so risky. This market is actually going to peak out, and it's going to roll over, and it's going to go down. Because of that, the only safe investment in this particular market is to be flipping your properties. The strategy in this market is to flip. Either hold on to your cash and wait for your market to stagnate and correct, because cash is king in a down market, or take that money and move it into an emerging market and watch it explode again and again and again. So a seller's market phase 2, there's still upside potential in this marketplace, but you need to recognize when you're in this particular phase and get out of it. You need to sell all your assets and get into a cash position. You know what? You may sell out while the news media is hyping up how great real estate is, and you may sell out and watch the market rise for another year, maybe a year and a half. And you may see another 10, 15, 20% of value come into the market. But don't worry. If you try to wait and try to time this market and hit the peak and miss it, even by a month, you're actually going to end up holding on your property for a good 6, 12, 18 months or more. Because at the peak of the market, everybody now realizes that it's at the peak and more properties come on the marketplace. So the market becomes oversupplied, and it's harder to sell your properties when the market is oversupplied. Not only that, on the backside is the seller's market phase 2. You're actually losing value because rent starts to decline as well. When rents decline, that means cash flow declines, that means value also declines. Let's take a look at some of the key characteristics of a seller's market phase 2. They are: the time on the market it takes a property to sell is increasing. Slowly at first, and this is actually our first indication that we are in a seller's market phase 2. This is our sell signal. Times begin to increase slowly at first, and then it really starts to increase rapidly. Supply on the market increases. As it takes longer and longer to sell property, more and more starts to come on, so there's more supply on the marketplace. Not only that, we're starting to see the end of the construction boom. It won't end until the market actually starts to crash. Because we're in the second half of an upcycle, the supply of properties coming onto the marketplace is huge at this particular point. Banks have continued to lend new construction even though they know that the market is starting to come oversupplied. There are less and less buyers in this marketplace. Sellers are waiting, but they're still getting their inflated prices on the front side of a seller's market phase 2. But on the back side of a seller's market phase 2, they're not getting those inflated prices anymore. The construction pipeline is excessive, and most importantly, business and job growth begin to slow. While job growth is the enabler of an emerging market, it also is the death of an emerging market as well. When jobs start to slow and business growth starts to slow, then it's time to pull out of the market. It's time to get into a cash position. You can still be flipping in this particular market, especially if it's in your own backyard. But if you're looking around your area in North America for another emerging market or another market to be investing in, you do not invest in markets that are in this particular phase. You only invest in your backyard in a seller's market phase 2. Now moving into a buyer's market phase 1. In the buyer's market phase 1, as you can see, this is a quarter of the way down the backside of the roller coaster. This is when you have your arms in the air and you're screaming, and you should be because the property values are taking a free fall at this particular time. The key characteristics of this particular phase is that the market continues to be oversupplied because there are not a lot of buyers in the marketplace to absorb it. Investors are on the sidelines and they're waiting because they know prices and rents are falling. They want to wait until the market's near bottom. They don't wait until the exact bottom, but they wait until they can see the bottom in the distance. When they can see the bottom in the distance, then they'll start buying again. Until then, prices and rents will continue to fall. The time on the market will continue to decrease as well until we can see the bottom in the area. Now I'll talk about exactly where the bottom comes from. New construction becomes stagnant because there's nobody buying these properties. There's actually, with job loss, there becomes an out-migration of people out of the marketplace. Because unemployment reaches its height and because foreclosures start to rise sharply, people are literally walking away from their properties. They're moving to where jobs are. They're moving to start a better life. There's no new construction, and there's a lot of empty properties that need to be rehabbed or repaired on the marketplace. Now, buyer's market phase 1, the prices of investment properties fall to their lowest level of all 4 phases. There's only one thing that is going to change a market's momentum from going down to going back up again. It's not going to immediately go back up, but that one thing is job growth. Job growth happens right about 3/4 of the way down your roller coaster. It's 3/4 of the way down, and there are 3 different phases of an emerging market. There are job announcements, job construction, and job fulfillment. Job announcement happens right here. It says that in an area, there are announcements going on. For instance, when Phoenix announced that Sun Microsystems was going to build a plant there, that was the first indication of activity in the marketplace. The local investors that had been through market cycles previously, that had the experience with market cycles, they started buying again. The market started creating momentum. But it wasn't enough momentum to shift the market around, to go up on the other side. That happens during the construction phase. Typically what happens in the construction phase is you'll have a lot of construction workers migrating in order to build the infrastructure for the different companies that are going down to go into a new marketplace. Sun Microsystems, they didn't create 20,000 jobs in Sun Microsystems. What happened was they brought 8 to 10,000 new jobs in, then the multiplier effect took hold. There were a lot of ancillary services or ancillary businesses that grew around Sun Microsystems. A lot of their suppliers followed them there. Because their suppliers followed them there was job growth. Not only that, for all the people that now moved into the city, new service jobs are created. The butcher, the baker, the candlestick maker, to take care of the new population growth that was coming into the city. For every new job going into an emerging market, there's what is called the multiplier effect. That means that 2 or 3 additional jobs are going to be created in the service sector to take care of the needs of the new job that's being created. Therefore, with the multiplier effect and those service jobs, those are typically the people that are going to be renting our apartments as well. As new construction happens, the first wave of people coming in are actually the construction workers. They don't plan on staying for a long period of time. They're going to rent apartments, and they're going to absorb the oversupply in the apartment sector. The apartment sector is going to be the first sector to move in an emerging market. Then it will go into the fulfillment phase. In the fulfillment phase of the emerging market, this is when the construction is done, and the new jobs are fulfilled with the new employees. This is when the market really starts to take off, because these are the permanent workers. Yet the apartment sector continues to rise. It rises faster than the single-family sector. It rises along with the office space and retail sector. They go hand in hand. Single-family houses don't rise yet. There's still a little bit of lag here. The new people that are coming into the area, they're not sure where they want to live yet. They're not sure if the job is going to last. So that they are going to wait about a year or so, because they usually typically sign a year lease until they get settled in. They're going to wait a year and go house hunting. Therefore, the apartment sector, the commercial sector, rises about a year before the single-family house sector rises. Your strategy in the buyer's market phase 1 is to hold for cash flow, because literally there is no appreciation in this market. Although job announcements are going to be a fortune teller per se of what's to come, and actually it's a leading indicator of appreciation that's just around the corner, but has yet to happen. There's still a little of a bottoming out to go. Let's go into the buyer's market phase 2. In the buyer's market phase 2, this is what we call the millionaire maker. This is the start of the emerging market. This is when you're in a market like this. You want to be buying with both hands. You want to be backing up the pickup truck and filling it up to the brim. In a very short period of time, you're going to see appreciation take off like a rocket ship. This is because the jobs have started to come into the market. The construction jobs and the fulfillment jobs are now in the marketplace, and the oversupply is being absorbed. Some characteristics of a buyer's market phase 2 is that the time when the market starts to decrease. Job growth increases, existing properties are being rehabbed, and prices begin to slowly increase. The key characteristic of this particular phase of the market cycle is that rents begin to slowly increase. They begin to slowly increase because absorption has come into the form of migration, people migrating to get those new jobs. They're absorbing the oversupply of apartment units on the marketplace. And because they're absorbing that oversupply, they're creating new cash flows in the apartments. When cash flow goes up, net operating income goes up, and values go up. We start seeing prices begin to rise in our apartment buildings, and it's a beautiful thing. The buyer's market phase 2 is the phase that all of us investors look into to make a windfall of profits. If we go back to the graph and we look at the buyer's market phase 2, which is at the very bottom of the trough, there's going to be 2 different types of investors. Each investor is going to be on either side of the bottom trough. Some investors are going to start investing while there's job growth and job announcements in the area, because they know, depending on the strengths of the jobs that are coming in, who's coming in and why, they know that it's a good indication where the market's going. Then you have what's called momentum investors. Momentum investors actually wait for the construction jobs to be fulfilled, for the ground to be broken, and for the permits to be released. Then they start buying as they see those rents starting to increase. Either investment strategy is good. I know I am both. It all depends on which particular market you happen to be in and your particular investment strategy. Let's go forward and talk about some good indications of what a good emerging market is, or some characteristics we look for in emerging markets. One of the characteristics that we like to see is a college town or a university town, because there's always an influx of new students, and those students are always looking for new housing. Not only that, Good colleges also produce students that create business in the area. We see business really congregate and cluster around a city that has a good, solid college foundation. We like state capitals, generally because they produce government jobs. When you have a combination of good college and state capital, you got a market that will rise, stagnate, and not really participate in the downside of the market cycle. That doesn't mean, though, we only invest in markets close to the state capital. When we're going into a market, we like to see new big box retail being generated. Big box retail would be Sam's Club, Walmart, Target, Home Depot, and the Lowe's of the world. Because these companies have probably done their homework, and they've looked at the demographic profile, and they see what's happened in the marketplace. And that just confirms what we're seeing also. We like it when our particular area is a healthcare hub, when people drive from miles around to go to this particular area to be serviced for their health needs. This typically makes for a good market. Every emerging market needs to have a strong leadership. We also like to see major interstates going through a particular marketplace. Interstates facilitate the transportation of goods and services. If the city is a transportation hub, that's even better. Another characteristic we like to see is a marketplace that has an airport, and at least one with a major carrier. Airports aren't a necessity of an emerging market, but we like to see it when we can. We also like markets that have 100,000 plus of population. We also like to see a city to be a shopping hub. A shopping hub is where the regional shoppings are, where the major mall is, and where people will drive from miles to be in this particular area. Based on everything that I just shared with you, you might be thinking to yourself, why should I invest in emerging markets? We just went over different characteristics of emerging markets, and we talked about the fact that emerging markets have great appreciation in a very short period of time. Actually, we're in the right market at the right time. That's the type of investing that we like to do. You're going to see a higher than average return on your money invested. Isn't that what it's all about? Getting higher returns on our money that are secured by real estate so that we can become wealthier faster and reach our financial goals easier and quicker. That's why we like emerging markets so much. What I've just explained to you is how an actual area develops and becomes an emerging market, and what the key characteristics are for you to get that higher appreciation. Initially, in an emerging market, when you're there early, there's not as much competition. You may be from a market that is very competitive, and you have a lot of different investors out there, and they're buying and selling on a regular basis. But remember, in an emerging market, we're on the back side of the market. Also, you can trade up faster to bigger properties with bigger profit potential. The power of investing in emerging markets combined with the use of 1031 exchanges makes your investment grow tremendously. 1031 exchanges can be explained at another time. If you're not familiar with them, feel free to contact me. I'll be glad to go over with you. 1031 exchanges help you become wealthier faster. Another powerful strategy is to use your self-directed IRA, also another topic I'll share with you when we speak. Why emerging markets investors invest like the institutions? I'm sure you heard of real estate investment trusts, REITs. They don't just invest in the city that they created the trust in. No, they look around, they look for the highest returns. They invest in the cities with the highest returns, and that's what you should be doing. When you decide to buy a stock in the stock market, you don't buy a stock in a company that's in your own backyard, where it has its headquarters. No, you look for the stock that's going to give you the biggest return. You look for the mutual fund that's going to give you the biggest return as well. Should you consider doing the same thing with your real estate investing? I would say yes. Go to the areas that are going to appreciate the fastest, and you'll become wealthier faster. I'm often asked, Brian, what is a current emerging market that you invest in? Well, in my opinion, and remember, what does an emerging market hinge on? That'd be job growth and migration of people. At the time of this recording, I like Texas. Let's take a quick look at a video. If you recall, when we started this presentation, we had three objectives. The first is to explain what an emerging real estate market is. The second is to have you discover the advantages of emerging real estate markets. And the third objective is to show you how you can take the next step and start investing in emerging real estate markets yourself. I want to offer you an opportunity to take the next step. Taking your next step will be very easy. What you need to do is contact our office now. Here is my contact information. When you contact us to hear about our current opportunities, we will ask you to fill out a questionnaire. It's a very simple one-page questionnaire, and we are SEC, that's the Securities and Exchange Commission. We're a compliant company, and we're required to have this simple questionnaire filled out by anyone interested in hearing about our specific deals. You simply fill it out and send it back to us. Then we are able to tell you about the properties that we have available or the different types of properties that we are investing in. When done properly, emerging markets will explode your wealth. I want to congratulate you for taking the time to watch this video, and I want to congratulate you for taking the next step. Don't forget to contact me right now to get started. I look forward to hearing from you, and thank you so much.